Welcome to the Value Investor Chatter. My name is Becco and my partner Hari. Welcome everybody. This episode we're going to talk about Affirm, pay now and maybe pay never, and we'll talk about that. It was a complete disaster. Not to give away too much, but it was a complete disaster in their earnings just yesterday. We are recording this on Friday, February 10th in sort of week early since Hari's going to be taking a vacation. So this podcast will be released next Thursday, but we are recording this on the 10th. So let's just jump right into it. Actually, before we do that, let's do a quick disclaimer, Hari.
Yep. This is the Value Investor Chatter podcast. We are a podcast that helps you grow your wealth. But we are for educational purposes only. Any companies that we talk about or any advice that we give here should be considered in the context of your financial advisor or with your tax professional.
Excellent. Okay, so let's get right into it. Affirm, what do they do, Hari?
So as Becco said, they are the buy now, pay never provider. I mean, buy now, pay later provider. So if you're at your checkout on an online store or actually in Walmart, you can use their service to essentially get various lines of instant credit. Some of them at 0% interest, and you'll have 4 cycles to pay them in many cases. But they even finance larger purchases like Peloton equipment, where they give you a longer term to actually pay it off. So essentially, they're providing you a micro or small loan for whatever purchase you're doing, and they appear on. I've seen them on many websites, including Amazon, Walmart, and much smaller stores as well.
Yeah. So they just announced their earnings. Actually, before we go to the earnings report, let's just quickly show you guys what the stock performance has been, because I think it'll give us a good base to talk about this company. So here we go. So Affirm Holdings, they went public in 2021. This is kind of in the middle of the pandemic when the zero interest rate environment, they sort of timed it perfectly, I would say, right? I mean, it's like a perfect timing for the IPO. They went public right there, and since then the stock has performed quite poorly. Recently in 2022 and 23, it's been completely hammered. So that's kind of the backdrop of the company. Company is currently, as you can see, the market cap $3.8 billion. So let's dig into it. Most recent earnings, they also, here we go. Affirm cuts 19% of workforce. Shares tank on earnings miss. By the way, this is a company that's founded by Max Levchin. He is one of the co-founders of PayPal. Anyway, so that's kind of the story here from bird's eye view. Let's dig into the fundamentals and how they performed in the last couple of quarters. I'll toss it to you, Hari. Let's start with let's start breaking down the company's most recent earnings report.
Yeah. So what I'm going to show you here is kind of is from their earnings supplement from the Q2 2023 report. So their Q2, not every company ends their year on the calendar year, their fiscal year. So they their Q2 covers the December time period. So don't let that confuse you as we talk through this. What they just reported was the quarter, the second quarter. And so their Affirm doesn't have a press release. And as you know, when we talk about these companies and we talk about their earnings, we look at the press release. Their press release was very short, and they referred to an earnings supplement, which is this shiny PowerPoint that they have where they try to make themselves look really, really good. And they highlight a bunch of things. One of the main things that they try and look at is this gross merchandise volume, which is when you buy your checkout at Walmart, and they finance for $100. their revenue will be a fraction of that percentage. So the amount in gross merchandise volume is the amount that you see on your receipt when you buy from Walmart or something like that. The revenue part will be the part where they collect off of that. So don't let the gross merchandise volume be, some like, oh man, it went up, 27%, right? The real number here is 11%. That's the revenue that they actually grow. So remember, this is supposedly a big growth stock. It's, supposed to go really fast. This growth in that mindset is very anemic. Their
By the way,
growth.
let me just point out one thing. Gross merchandise volume, GMV, is I think is what a lot of company calls it. The
Yeah.
GMV is a common metric in this line of business, right? Visa reports GMV. I think all of the payment rails companies, insurance payment rails, just consumer payment rails, all of them report this number. But like you said, what's important is what do they actually keep out of the gross merchandise volume? Anyway, just for
Yeah.
a little bit more context. Okay, let's go to the revenue side. You're saying.
Yeah. So just looking at that growth, you see that it went up 27% on the gross merchandise side, but the revenue growth only grew 11%. So what that's telling you is their ability to actually monetize from merchandise value to revenue is actually shrinking also. So this is a story that you wouldn't see if you're looking at the uh, like the transaction. You looked at this highlight and you say, wow, their growth is great. But these are the things to pay attention to when you're evaluating a business like a fintech company. Um, so
Actually, can you go back for a second?
yeah,
It is interesting to see actually the third chart there.
yeah,
Transaction per active consumer. It grew by 38%.
mhm,
Active consumer numbers grew by 39%. Gross merchandise volume 27%.
yeah,
It seems like the number there is the number of consumers have grown more so than the actual gross merchandise volume, meaning that the you know per transaction
yeah,
it's the rate of growth for number of consumer is faster than the volume, the payment volume per consumer. Anyway,
yeah.
this is the top line stuff that doesn't really matter to the business fundamentals. Let's keep going.
So just uh, we saw that that they actually partner with a bunch of different e-commerce companies, and they're showing you that their different rates. General merchandise grew a lot, but some interesting things to me were that their electronics, which is where a lot of people are going to finance things, the number of partnerships actually shrunk during that time. So number of partners that they were actually working with is actually getting smaller in some cases. So just something to think about when in the back of your mind, because um, their consumers are actually going up, and they're saying that their transactions per consumer, which is what we talked about, was going up. But as Becco mentioned, the gross merchandise volume was shrinking, or it was growing at a slower percentage. So that means that the consumer is actually buying smaller transactions on Affirm's platform, even though they're doing a larger number of them. Just these are all math things that just to try and keep wrap your head around as you go through this. Because remember, our job as an investor here is to evaluate whether a company is worth our time, right? This company is a dumpster fire, so it's not worth your time. But for educational purposes, we are teaching you how to not put your hand in the dumpster when it's on fire, right? So that's the whole goal here. Um, so from a revenue standpoint, though, the growth was only 11% um, from Q2 last year to Q2 this year. And this has a number of factors that we'll get into. But why we're highlighting this is the whole investment thesis for a lot of people is that this is a growth company. But what is actually happening? Remember, they've already hit Amazon, they've already hit Walmart, the two biggest platforms where you can buy stuff online. Um, and their growth is fairly anemic, right? So this should tell you that this isn't actually the number of people who would use this service um, is they've probably maxed out that, and it's now about increasing the number of times those people use it. Um, So which may not actually work so great. Um, so another point to highlight is, and they talked about this in um, the earnings call, is that the number of, we talked about they had a 0% interest for 4 months. If you pay it off in 4 months, you get 0%. The number of transactions that they're actually going to be able to do that at is going down, because of
Is there a chart for that, Hari, in the
um,
PowerPoint?
I don't think they do that because this is um, this may be the best one to get that information. Um, but you can't, as far as I can tell, you can't tease it out of this presentation.
Sure.
Uh, so, but let me just explain that point, and then we'll. So imagine that you're a company like Affirm is effectively a bank, right? And they are making loans to businesses or to consumers at the point of a transaction. So they're trying to do some sort of very quick calculation about a consumer's ability to pay this off, offer out the loan, and then they work with the merchant to then develop some sort of payment in the case that they pay it off in 4 months at 0% interest. Affirm is still trying to take some money. If this goes beyond 4 months, there are loans and interest rates that kick in and things like that they try and collect money off of. So just to get a little bit deeper into their process, but the problem comes into for them is when you have a higher interest rate environment, the default rate for this goes up. Not only that, though, that when the default rate is higher, or the economy doesn't do as well, the percentage of their borrowing costs will go up. And so their actual, because they have to keep a higher provision of loans that are going to be in default at a higher cost to them, right? So this is part of the squeeze that we're going to see. We're going to talk about, as we go through there. So I'll stop there. If Becca, if you have any comments, then I'll show you a couple more things.
Yeah, I think this is, again, I think we mentioned this over and over again, and this is such a moot point now that I've mentioned it like 5 times in the previous podcast. All of this stuff, especially this one actually, because this is so tied to the interest rate and the macro kind of trend, is that all of the stuff that we're seeing of misallocation of capital is downstream of loose monetary and fiscal policy. And this is, I think, a good example of this. And yeah, so I'll just say that. And I think this goes to show kind of we're going to talk about different types of squeezes that we're seeing. The cost of capital is going up. You got a lot of the competitive advantage being eroded away, going away. So yeah.
So let's actually look at their transaction costs. We saw that they were going up, and they do this as a percent of their gross merchandise value. So you can actually see their transaction costs going up significantly in the last 4 years in the last 4 quarters after being relatively flat. So this is, we're now talking about eroding their margins, right? Well, they didn't have any margins to begin with because they're not a profitable business. But this
Sorry, Hari, are you sharing
in.
your screen on the other one, or I'm still seeing the PowerPoint?
Yeah, I'm talking about the transaction cost
Okay,
here.
got it. Okay.
So so that since the transaction cost goes up, we'll show you their margins here in a minute. But effectively, this is going to hit them by causing their losses to accelerate, right? And so let's just actually look at that right now. So their operating expenses have gone up significantly as a percentage of revenue, or in the last 24 months, from 18 to 22%. So these are people and technology costs.
Right.
So non-GAAP operating expenses has gone up as a percentage from Q2 of 21. So this is their cost to actually provide, their platform, their services, etc. and they're cutting sales and marketing expenses um, to try and get more profit, which is going to affect their ability to keep their growth going, right? As we've seen, um, and and they may also mark sales and marketing expenses as promotional items and offers that they have, to get more people to use the service. Um, so the last thing I want to just highlight, and then we'll talk more about the squeeze, is their operating losses continue to accelerate. Um, their operating margin was terrible to begin with because they've never been profitable, but this is going to continue to get worse over time um, if they don't significantly change their business model, right? I mean, I don't know how to rectify what they're doing and this concept of short-term credits and finances, because there's so much competition in this space.
Yeah.
So
This sort of ties back to the comment that we made earlier. If you stay on that graph for a second, you got GAAP operating income slash losses on one side, and then you have adjusted operating income and losses on the other side. Is it funny? Is it kind of surprising to you that the adjusted operating income looks a lot better than GAAP operating income?
yeah,
Uh,
they're going to adjust it for their benefit, right?
yeah, yeah.
So
Yeah, I mean, I think the main point is that the top line is it's still growing, but maybe not as aggressively as it was in kind of the heydays of 2021 and 2022 with zero interest rate environment. But also the operating losses are compounding over time. I can't really make out the number there. It's like growing at 90%. Is that
yeah, the
right?
margin is negative 80%, I think, from 54.
Yeah. So yeah. So and then you have to ask yourself, what is the difference? Why is it that the gap is widening? I think one of the factors that I think Hari you just mentioned is the provision for the future losses, the credit loss or the loss on the credit that they issued. And I think perhaps this is a good time to show this chart. So let me share my screen, Hari.
Yep.
Let's see. Let's let's go here. All right. The company, as I mentioned before, the company is so tied to the macro environment because effectively they're a bank, and banks obviously are extension of the kind of the Federal Reserve rate setting, and they're the ones that can kind of create money through credit, blah blah blah. So they're very tied to the macro space, and you can look at this delinquency rate on credit card loans. I've just truncated the timeline from 2015, but if you go back all the way to like 2008 crisis, for example, you can clearly see the delinquency rate goes up when the recession begins, right? And so this
Mhm.
is kind of what you're seeing here is that when the interest rate, and also this is quite fascinating here, since the collapse from 2008, you've seen the delinquency rate gone down and has stayed down for a long, long time now. So, and then you got 2022, 2021, and then you're starting to see a little bit of pickup here on the credit card delinquency rate. Same thing for consumer loans, all commercial banks. You can see it's starting to tick up a little bit. So this is a fresh or not a fresh, sorry, Affirm is kind of playing in this context that we're talking about here.
Yep.
So is there anything else on the slides that you want to talk about?
So I mean, I think you know one of the things about looking at a company like this, right, is as value investors, we would never really look at this business, right? It's got a lot of things that we're not interested in, right? One is a very short operating history in terms of public perform operating history, right? They went IPO'd only 2 years ago. Two, they're in a space that is where I mean they're at a stage in their company where they're not profitable. And three, so they're in a relatively new industry in this fintech space, right? So value investing is really about looking at a business that's, generally profitable, that you can value. So we would pass on a company like this, right? And Becca and I have looked at this farther than we would normally do in our own value investing practice, because it's not really interesting, right? This company, is not really interesting from our perspective, but from a educational perspective, right? There's a lot to see here about how they've mishandled a lot of things. They have a broken business model that really is not providing anything different than, say, your credit card company, or other things. And they may differ, they may disagree with what I'm saying, right? But in my opinion, there is no real benefit to something like this. Um, because they're trying to partner with the retailer and stuff like that. That doesn't mean that this is, something that's really going to drive sales for that company, right? And so I think what is going to happen is Amazon, Walmart has plenty of money. They have the ability to do all of this stuff. If they wanted to, they could do this themselves. The reason they're not doing it is they don't want to take on the risk and have to go to collections and other things, right? So they'd much rather just say, look, credit card company, you deal with it, or some third party business deal with it. Because if it was truly a profitable business, they would do it themselves, right?
And then they surely can. They're sitting on a lot of cash. I mean,
Yep.
really, effectively, a bank is a way to lend out access to the balance sheet. The way I think about it is just basically a bank is just access to their balance sheet. If you have a bigger balance sheet, you can kind of become a bank. And like you said, all these companies that they're partnering with, Walmart, Amazon. Just a side note, I think the most egregious part about this whole thing is they partner up with Peloton. And I think there's a slide just dedicated to Peloton partnership in that slide, right?
Yep.
And I mean, geez, I don't know what's going to happen to Peloton. That's a whole nother story. But it sounded like a lot of the customers of Peloton bought their bikes through through Affirm. Um, yeah, so double whammy for Peloton, I suppose, and Affirm. Yeah.
Yeah. I think there's a lot to learn here, right? But not necessarily an interesting company to invest in. And my thought here is, well, one, I would say, like, we have a lot of lively discussions about companies on our value investor community, and we'd love for you to check them out on valueinvestor.org. Come to our site, check it out. Join the community. You'll be able to chat with us about companies like this, and also talk about companies that are more interesting from a valuation perspective, that you may actually want to be invested in or put real cash into. So, but if you hit us up on valueinvestor.org, we'd be happy to continue the conversation about companies like this, or the companies that we talked about. You'd also be able to check out our free database of stocks, where you could actually see the history of a firm or any other company in the investing universe. And at the same time, you could, if you're like, I don't know what these guys are talking about, you can actually take our course, which will help you get up to speed on the actual mechanics of value investing. What do we mean when we talk about revenue, operating income, profit, free cash flow, all of these terms that Becco and I throw around, common investor terms, you may be confused by it. I think you would get a lot of benefit by taking the course. And that, I think, would help get you up to speed, so that when we talk about these on an ongoing basis, you'll be able to follow along a lot quicker. But, I think just the larger point that I would have with any business that you're going to evaluate from an investment perspective, from a finance perspective, anything that you're looking at, it's always good to investigate companies like this, because it helps you hone your skills of essentially smelling BS, right? This company has a significant problem. It's going to be eventually, I think, lead to bankruptcy, or get folded, because there's no way to get around, and now the higher interest rate environment is just going to squeeze out their process, right? Or they're going to have to charge the company more that they're dealing with, the retailer, more, and they may not find that valuable, to them, right? Because it cuts into their margins at Amazon and Walmart.
Yeah, those are all good points. Yeah, definitely check us out. Check us out on valueinvestor.org. Got a lot of free resources there for you guys also. Yeah. I'll just say one last thing on Affirm. I think for me, we go through a checklist. By the way, if you guys want to go through a checklist, we have a checklist that we use to go through every individual companies that we analyze. If you guys want that, go to valueinvestor.org. It's available for free there. One of the things that we spend a lot of time on is actually qualitatively analyzing companies and coming up with coherent arguments as to why this company has a good competitive edge, competitive moat. One of the things that I find, at least personally, I don't have the expertise to look into banks and bank adjacent kind of companies like this, is because, well, first, I don't understand them very well, and secondly, what I find kind of disturbing about putting my own money into the companies like these is that they're at the mercy of they're at the mercy of Federal Reserve, central banks around the world. One of the things that I learned over the past few years is that a macro environment does matter, and with zero interest rate environment, anything goes. And when the environment is not zero interest rate, things start to look really bleak for some of these companies. So I don't want to be in a position where a group of elders come together and decide the value of your dollar, and somehow like your business model completely breaks. So that's just kind of how I think about some of these plays. But and partly because, like I mentioned, I will confess my ignorance on analyzing some of these banks because they're just so difficult for me, and I don't have a full grasp on this. But just as a general theme, I tend to avoid companies that can be written off with some variable lurking that's exogenous to the company. So there you have it, guys.
Yep.
That's Affirm for you. Hope you guys enjoyed it. Leave us a comment, like, subscribe, and definitely come check us out on valueinvestor.org. All right. Until next time, see you guys.
Thanks.